Welcome to the Deep Dive, where we sift through dense research to bring you the core insights quickly and clearly.
That's right.
You're the learner, someone who wants to grasp important topics, from all angles, have those aha moments, and come away feeling informed, not overwhelmed.
And today we're plunging into a really fascinating study. It offers a potentially game-changing perspective on what really drives stock returns.
Okay.
We're tackling the 2009 Journal of Political Economy paper, Investment-Based Expected Stock Returns by Liu, Whited, and Zhang.
Okay, so the mission for this deep dive is to understand how this research connects a company's own investments to what we can, anticipate from its stock. The central idea is pretty powerful.
Yeah.
The authors propose that when things operate under consistent rules specifically, constant returns to scale a company's stock performance is directly linked to how well its investments perform.
Exactly. And these investment returns, they're tied to things about the company we can actually see and measure, observable characteristics.
Right, observable things, not just investor moods.
Precisely. This approach kind of flips the script on some traditional thinking. Instead of focusing primarily on investor psychology and preferences, it shines a light on the company itself, its operations, the strategic choices it makes.
Where it puts its money.
Yeah, where it puts its money as the fundamental drivers. The characteristics they zero in on are things like, say, unexpected jumps in earnings.
Earnings surprises.
Right, or the relationship between its book value and its market value book to market, and also just how much it's actually investing in new equipment, technology, that sort of thing.
Interesting. So it's a shift in focus. Where did this fundamental idea, this shift, come from?
Well, this research builds upon what's known as the Q theory of investment.
Q theory.
Yeah. While the initial ideas were developed way back by Brainerd and Tobin, it was really John Cochran's work that connected this theory more directly to the stock market.
Okay.
And what's compelling here is that Q theory lets us analyze stock performance without needing to make, big assumptions about investor behavior, which can be pretty unpredictable.
All right. Less psychology, more economics.
Exactly. It focuses on the core economic problem of the company. How does it decide to invest to get the best return for its shareholders?
Okay, so this Q theory is the bedrock. Now, what's the key link, the equation maybe, that bridges the gap between a company's investments and its stock returns?
The core idea, in a nutshell, is that a company's stock returns essentially equal its levered investment returns.
Levered. Okay, unpack that.
Right, that word levered is key. It refers to the fact that most companies don't fund everything with cash on hand. They often borrow money, use debt.
Leverage.
Leverage, exactly. This borrowing acts like a kind of multiplier. It amplifies the returns generated by their investments and, as a result, magnifies the returns and the risks that stock investors experience.
So more debt means bigger swings.
Potentially, yes. For a given change in its underlying investment returns, a company with more debt will likely see a bigger swing in its stock price.
Got it.
Yeah.
So how do these characteristics, we mentioned the earning surprises, book to market, how do they actually plug into these levered investment returns? What's the mechanism?
Well, the connection happens because companies are always, or should be always, trying to increase their value. To do that, they need to make smart investment choices.
Makes sense.
The paper makes a crucial assumption here, using a Cobb-Douglas production function.
Okay, sounds technical.
It's a standard way economists model how efficiently a company turns its resources, capital, labor, into sales. The key takeaway here is that the marginal product of capital, basically how much extra output you get from one more unit of capital, is proportional to the sales to capital ratio.
Yeah.
So the more sales a company generates with its existing assets, the more attractive further investment becomes. Higher efficiency signals higher potential return on new investments.
Okay, so a good sales track record boosts the case for investing more. What else influences this decision?
Another big factor is something called investment adjustment costs.
Adjustment costs. Like the friction of actually doing the investment.
Exactly. The paper models these as quadratic, meaning they increase at an increasing rate. Think of it like this. Starting a small project is relatively easy.
Yeah.
But trying to rapidly scale up, that brings increasing headaches, disruptions, hiring and training needs. Maybe things just don't run as smoothly when you rush.
So it gets harder and harder to invest more quickly.
Right. These rising costs put a kind of brake on how much a company invests, and those investment decisions directly impact the returns.
Okay, so there's a natural governor there. Now, you mentioned marginal Q earlier, I think. How does that fit in?
Yes. Marginal Q. It's a way to think about the future profitability of an investment. Imagine it like getting a glimpse of the discounted present value of all the future extra profits a company expects from investing in one more unit of capital, like buying one more machine.
So the expected payoff.
The expected payoff, yeah. A rational company will keep investing as long as the cost today is less than or equal to this expected future stream of profits, the marginal Q. So marginal Q acts as a signal, is more investment worthwhile right now?
Okay, it's coming together. Theory, costs, future value. Now, how do we actually calculate this investment return? What are the main parts?
So the paper lays out a specific equation. It's equation 3 in their paper that breaks it down. First, you've got the immediate after-tax profit from that extra bit of capital.
With the direct earnings.
Yep. Second, there's the reduction in those adjustment costs we talked about. If you invest a bit less this period, you avoid some of those increasing costs.
Okay, cost savings.
Third, the depreciation tax shield. Companies get tax savings as their assets wear down, right? That's part of the return.
Tax benefits, right?
And finally, it includes the expected future value of that extra capital, even as it depreciates over time. It's continuation value. So it's a mix of immediate gains, avoided costs, tax stuff, and long-term value.
That seems much more complete than just looking at next quarter's profit. Now, let's bring leverage back. How does that connect this underlying investment return to the actual stock return people see?
Right. That's equation 4 in the paper. It essentially shows that the investment return is kind of weighted average. It's weighted between the return on the company's stock and the return on its bonds, basically, after taxes.
Okay, weighted by what?
Weighted by the company's market leverage, how much debt it has relative to its total market value, debt plus equity.
Ah, okay.
And a really key insight here, which actually came from Cochrane's earlier work, is that if a company had zero debt,
Pure equity financed.
exactly. If it had no debt, then its stock return would be exactly the same as the return on its underlying investments. Leverage is what drives that wedge between the two.
Interesting. So if we can estimate the investment return and we know the debt level, we can theoretically get a better handle on the expected stock return. But is this just theory or does it hold up in the real world? How do they test it?
That's the million-dollar question, right? Does it actually work? So the researchers dug into real-world data for U.S. public companies.
Okay.
They created different groups or portfolios of stocks based on those 3 characteristics we keep mentioning. Standardized unexpected earnings, SUE, book to market, BM, and corporate investment, CI.
Right, the observables.
Exactly. For SUE, they looked at earnings surprises from 72 to 2005 using a standard method. For BM, they used the famous Fama and French approach, sorting companies from 63 to 2005 based on that book of value to market value ratio.
Okay.
And for corporate investment, they looked at firm-level capital investment, again from 63 to 2005, following another established methodology.
So they sorted stocks into buckets based on these real characteristics.
Right.
What then?
Then they used a statistical technique called the Generalized Method of Moments, GMM. Yeah. It's basically a way to compare the average levered investment returns their model predicted for each portfolio against the actual average stock returns those portfolios delivered over those decades. They were checking, does the model's forecast match reality on average?
What did they find? Did the investment-based model do a good job?
It actually did remarkably well, especially when they compared it to the big traditional models like the CAPM, the Fama French 3-factor model, even a consumption-based CAPM.
Better than those. How much better?
Significantly better, at least for matching average returns. Take the portfolios sorted by earnings surprises, SUE. The Q-theory model had an average error, what they call the mean absolute error, or MAE, of only 0.7% per year.
0.7%. Okay.
Now, compare that to the CAPM. Its error for the same portfolios was 5.7% per year.
Wow, that's a huge difference.
It really is. It's not just tweaking things. It suggests this investment perspective might be capturing something fundamental that the other models miss, at least about average returns over time.
And did it work for the other characteristics too? Book to market and investment.
Yes, similar story. The Q-theory model consistently had much lower average errors in explaining the returns for the BM and CI portfolios compared to the traditional models. And importantly, when looking at the difference between the highest and lowest portfolios, like high BM minus low BM, the Q-theory model had almost negligible errors, while the other models still struggled.
Okay, that's pretty compelling evidence for explaining average returns. But averages aren't the whole story, right? What about volatility, the ups and downs?
You're absolutely right. Returns aren't smooth. So the researchers pushed the model harder. They asked, can it simultaneously match both the average returns and the volatility, the variance of those returns?
A tougher test.
A much tougher test. And when they did this, they found the model's predictions for volatility were, well, generally in the same ballpark as the actual observed volatility.
So reasonably close.
Reasonably close, yeah. For instance, across the SUE portfolios, the average predicted volatility wasn't miles off the real-world volatility. Same for the other sorts, too.
Okay, that sounds promising then. No major red flags there.
Well, there were a couple of wrinkles. First, the model predicted a positive relationship between volatility and book-to-market higher BM stocks should be more volatile, according to the model. But that's not really what you see consistently in the data.
Oh, a mismatch.
A bit of a mismatch, yeah. And second, when they forced the model to match both average returns and volatility, the errors in predicting the average returns actually got bigger again. They ended up being more similar in size to the errors from the traditional models.
Okay, so a trade-off.
Mm-hmm.
It could get the volatility roughly right, but it lost some of its edge in predicting the average returns when doing both simultaneously.
Exactly. It's not perfect, especially under that tougher constraint.
But let's circle back to where it did excel matching those average returns. What are the underlying economic reasons? Why do these specific characteristics seem to link to expected returns in this Q-theory world?
The investment return equation itself gives us the clues. Think about its components. The marginal benefit of investment, how profitable is the next project, linked to the sales to capital ratio, that's a big driver.
Right, potential profitability.
Then there's the growth rate of investment. How quickly a company is expanding its capital base acts a bit like a capital gain factor influencing returns.
Okay.
Interestingly, a high current level of investment relative to existing capital ratio. A high investment to capital ratio often signals lower stock returns going forward in this model.
Lower returns from high investment. Why?
It could be that really aggressive current investment implies maybe fewer great opportunities left down the road, or perhaps it signals over-optimism or over-investment by management. That's the interpretation.
Okay, what else?
Depreciation matters too. If a company's assets are expected to depreciate faster in the future, that tends to imply lower average returns, all else equal. And of course, leverage. As we discussed, higher current debt levels tend to amplify everything, leading to higher expected stock returns, holding other things constant.
It's like these different firm characteristics are sending signals about future profitability, risk, and investment opportunities, and the model tries to read those signals.
Precisely. And the researchers did these accounting exercises to see which signals mattered most for different types of stocks.
Right, what did they find there?
Yeah.
Which parts of the investment return mattered most?
Well, it varied. For those SUE portfolios, the earnings surprise ones, the key seemed to be the expected growth in that marginal Q we talked about. Basically, expectations about future investment profitability.
Future prospects.
Yeah. For the book-to-market BM portfolios, it was more about the current investment to capital ratio and the level of market leverage. Both were important.
Current actions in financing.
Mm-hmm. And for the corporate investment CI portfolios, the single most dominant factor was just that current investment to capital ratio. How much are they investing right now relative to their size?
That's really useful. It suggests different things might drive returns for, say, value stocks versus growth stocks or high investment firms.
It certainly points in that direction, yes. Different parts of the investment story matter more depending on the firm's characteristics.
Okay, one more puzzle. The model made a pretty strong prediction about correlation, didn't it?
It did, a very strong one. Theoretically, stock returns should be perfectly correlated, like one-to-one, with these levered investment returns at the same time, contemporaneously.
Perfect correlation. That sounds unlikely in the real world.
And indeed, it was. When they looked at the actual data, the simultaneous correlations were actually weakly negative.
Negative. The opposite.
Yeah, kind of puzzling. And this is a fascinating twist, they found that the correlations were positive if you looked at lagged stock returns. So today's investment return was positively correlated with yesterday's stock return.
Huh. So a delay. How do they explain that? Why the lag?
Their explanation, leaning on some earlier work by Owen Lamont, points to investment lags. Think about it. A company doesn't just instantly adjust its investment plans the moment the economic outlook or its stock price changes.
It takes time. Planning, approvals, ordering equipment.
Exactly. There are decision lags, implementation lags. So if something changes today that affects the discount rate or future prospects, the stock price might react immediately as investors process that news.
Market reacts fast.
Right. But the company's actual investment spending, the physical investment response to that same news, might not fully show up until next quarter or next year even.
So the stock moves first, the investment follows later.
That's the idea. This delay could explain why the current investment return doesn't line up perfectly with the current stock return, but why it might align better with past stock returns that were already reflecting those changing expectations.
Okay, that makes intuitive sense. So let's try and wrap this up. Bringing it all together, what's the core message from this deep dive into Liu, Whited, and Zhang?
I think the fundamental takeaway is that this Q-theory model, by really focusing on the company's investment decisions and its observable characteristics, gives us a valuable framework. And in some important ways, especially for average returns, it seems to be a more accurate framework than traditional models that lean heavily on investor sentiment or broad risk factors.
So the real aha moment for you, the learner, is perhaps that paying close attention to a company's actual investment behavior, its earnings surprises, its book-to-market, its capital spending, might offer a more direct, maybe more reliable insight into its expected stock returns than just trying to guess market psychology.
I think that's a great way to put it. But it's also crucial to remember the limitations, right? It's not a magic formula.
Definitely not perfect.
No. Especially when you push it to explain volatility and the exact timing of correlations, it shows some cracks. It's a powerful lens, but not the only one.
Right. So here's a final thought for you, learner, to mull over. Given these findings, how should you think about the information you see about a company's investment plans, its financial ratios, its earnings reports, when you're considering potential stock returns? Does this investment-based view give you a different angle, a different way to evaluate opportunities? And what further questions does this raise for your own research or how you understand the market? Thanks for joining us for this deep dive.